Good morning, everyone. Good morning, trade pros. Good morning, all. Welcome to yet another week of the markets. And this is the first full week of September that we've had. And there's a few things to note this week as we get this thing started. We have a period of time where realistically the volatility and volume in the market is supposed to ramp up, right? We are a week post Labor Day. Last week was a shortened week, so we didn't see as much volume and volatility come into this market. There is a start to a step up, and this week is going to be very important and realistically going to have more volume because there's multiple different factors that are going to come out. We have the CPI this week. And this is the last CPI report before next week's Fed announcement, which is expected to hike rates, right? The expectation from last week, 84% expectation to hike a 75 basis point rate hike into the cycle. Let me just check these FOMC Fed Watch futures countdown thing, because the CPI data is probably going to realistically shape up this the probability coming into next week. There's right now an 88% chance of a 75 basis point hike, and we could see potentially softer inflation expectations based on a lot of these energy prices, which contributed to the downside of the inflation data last time around. Sorry, just confused there for a second. We also have OPEX coming out this week, right? The quad, which so we have futures and options that do expire into Friday, so that's going to be an interesting day. And the main topic of conversation is going to be the CPI data that comes out tomorrow pre-market, which is going to be important and very interesting. And we also have the PPI coming out after that, and then next week leads into the Fed announcement. So starting today, right, there is a potential new inflation threat that a lot of people do have to consider. Because with the inflation data, the CPI report, we'd have to look at each individual area where inflation has risen versus where inflation has decreased. Now, if energy prices, or I should say crude oil prices, have dropped, right, as they have the prior month, that led to a 7.7% decrease in that aspect from the CPI data, which printed a softer print. But if you take a look at the data itself, you had other things like shelter and food that rose about 10%, which kind of counterbalance that. But you see this number dropping year over year, right, on a monthly basis, and you're thinking, okay, well, that's the top, right? Inflation has topped out. Now it's the same thing. If we print the softer CPI number tomorrow, the main CPI number, people are going to start thinking, okay, well, now we're truly done without taking a look at what's going on in each of the individual areas. Now, the next potential inflation threat comes out, and starting today, U.S. freight railroads are poised to cut back on some services with new union rail contract up for negotiation. So the reduced service will come ahead at a potential rail strike on September 17th if talks fail to progress. So while 10 of 12 railroad worker unions have struck deals, the holdouts, Brotherhood of Locomotive Engineers and Trailmen, and the International Association of Sheet Metal Air, Rail and Transportation Workers account for more than 90,000 rail employees. So while the preparatory actions are necessary, they do not mean that a work stoppage is certain. The Association of American Railroads said in response to the developments, the railroads want and continue to advocate for a prompt resolution that would provide historic wage increases to rail employees and allow the railroad to continue servicing customers and prevent further disruption to the struggling supply chain. So the main aspect here, keyword struggling supply chain. So this railroad strike could disrupt retail industry giants just like Walmart, Target, Home Depot if these domestic trucking rates accelerate again. FedEx and UPS could also be impacted from this, and economists warn that an extended rail strike could weigh on food prices and be a huge contributor to the inflation in the US, while the Association of American Railroads estimates that the strike would cost the economy about $2 billion per day. So nothing is set in stone, but this could be another one of those inflation fear increases. Because again, if you start disrupting the supply chain, which has already been drastically beat up, you're disrupting the retail industry as well as food prices, which is a huge component of that CPI data, which if this does continue, let's say for 4, 5, 6 days, whatever the case may be, you're costing not only multiple billions of dollars, but those key aspects of the inflation data are starting to rise from that alone, right? Even if crude oil continues to drop. So just keep that in mind as we come into the end of the week, where by September 17th, if there's no deal struck, we could expect something like that from the railroad industry. Now, related tickers, Berkshire Hathaway, right, BRKB, Brookfield Infrastructure Partners, BIP, Canadian Railway, naturally CN, Canadian Pacific Railway, CSX Corp, Norfolk Southern, and Union Pacific are going to be a lot of the stock names, ticker names that could be affected by it. So go check those out, see how we ride into the end of the week. Now, we also have ETFs to talk to. So this is a pretty interesting aspect. There are a lot of ETFs out there, and it has been a popularity contest, I guess, and a fight for the lowest expense fees, because ETFs, right, they were created to kind of give us more of access to the overall stock market, right, with a basket of goods without having to buy each individual stock, weigh them, do this and that, right? And a lot of them do reflect the S&P with lower expense fees than the SPY. So especially now in a time where there is a lot of fear in the market, there's not that many ETFs that have launched necessarily, because it doesn't seem like the best time to launch, but there has been a continuous battle over cheaper ETF fees, as well as ever growing suite of products and investing angles. So we know that BlackRock, BLK, and Vanguard rule about more than 60% of the US ETF market, which has expanded by nearly fivefold from 6.6 trillion to from 1.35 trillion to 6.6 trillion about a decade ago. But the rivalry has grown more and more intense over the recent years. So since the start of 2020, Vanguard has recorded inflows about $656 billion, right? Versus BlackRock's $411 billion, which it bought from Barclays in 2009. So while BlackRock markets are a broader range of ETFs and target bigger institutional investors, Vanguard has emphasized its standing as a lower cost provider to attract retail investors and financial advisors. Vanguard, right, the VOO ETF replicates the SPY ETF very, very closely with a way lower expense fee, and it's suitable. The reason why I bring this up is we're in a position where we could see one of those generational dip buys in the market, and suitable for those investors that are more passive, those investors that don't necessarily want to stock pick, those investors that want pretty much something like the SPY, but VOO offers a lower expense fee, and that could be something that could be interesting in the coming months or whatever the case may be. Now, with that being said, right, when you come from a trading standpoint, right, it's not like you're going to trade VOO options, for example. The SPY options are going to still be more liquid, but there's a lot of different players coming into this ETF game that create these tradable assets for short-term traders as well as investors. So we're playing a different type of game. We want to lead, and it's also about expanding ETF usage across all client types. That's the most important, says Armando Senra, head of iShares America. We are looking continually to expand the offering, and we will be very judicious, added Vanguard's Dan Reyes. We tend to stay away from thematic or narrowly sliced versions of the universe, which is something that you might see through ARK, for example, where they're very niche in what's going on. And Vanguard and BlackRock do have these very larger general ETFs that are sliced, right, differently, right? You have a little more growth in some of them, you have a little more value in some of them, but generally they do follow similar principles. Who will win this race realistically? BlackRock's iShares Core US Aggregate Fund Bond ETF, AGG, is close to being surpassed by the Vanguard Total Bond Market ETF, BND, which is one of my more favorite bond ETFs, I would say, as the world's largest bond exchange traded fund. And however, BlackRock still has 2.96 trillion global ETF assets compared to 2.04 trillion for Vanguard at the end of July. Though the latter is catching up. Meanwhile, the largest ETF asset across the States Street Spider S&P 500 trust the SPY, but BlackRock and Vanguard still dominate the next 15 out of 16 rankings. So naturally, the SPY is the largest expense fee, but also largest liquidity and volume. So if you're still looking to trade those ETFs and be a little more active with them, the SPY is realistically the way to go. So far this morning, pre-market, we have uh, a pop, right? We've got a gap up in these equities. I was looking for a little move to continue to the upside, to start off the week and into the CPI and uh, potential softer CPI numbers to come out. So there's a few key levels that I want to make sure that you guys understand here on the S&P 500 futures. The first massive support is going to be found at 40.80, 40.82. That's going to be the lows of the overnight session, but it's also going to be a huge distribution point for the last few days here. We want to see that area hold, right? That's kind of the last chance for the day, I would say. We have a massive area at 40.90 to 40.91 and a huge area at 4104 to 4107, right? I do understand it's a wide range, but you start accepting through that area. What we've done is we've actually started to accept through a large distribution block that does open up the upside for my weekly target, which might sound kind of crazy, but is going to be 4160 to 4165 to the upside is my weekly target, especially if we start accepting through this distribution block, which does start around 4105-ish to 4107, right? In that area, you start accepting through that, you're going to look for that 4116 to start, 4130 and 4141, right? Those are going to be the upside targets for the day. And I just want to see if we can accept through that distribution block to really get us into that next level. So I am leaning a little more bullish, right? I think there's a little more bull in this. The market maker positioning is holding out a little more to the bull side as well. And if we start maybe at some point this week, I don't know, but you get under 40008, 4010, that is going to be the pivotal flip point for the market to say, you know what, like we're done with this. And that is the downside move where we go and accept into a distribution block that does open up lower. So keep that in mind as we start the week. And let's see, this week, today, I'm not expecting too much crazy movement and volatility because we have that CPI data that everyone's going to be watching and waiting for coming into tomorrow at 8:30 a.m. Eastern pre-market. So that's what we're going to be getting ready for. We're going to be trading that in our live futures room tomorrow morning. And I hope everyone has an amazing start to the week. Start slower, start smaller. Remember, CPI is on taps, and come check us out on our website for our futures and options master classes. We'll see you guys in our open rooms as we get this week started. And ideally it stops raining in Toronto so we could have an even better start to the week. So thank you all. And I hope everyone has an amazing start to the day. Let's keep it small. Let's keep it diligent to start the week off. CPI is right around the corner, and let's get into it. Thank you all, and we'll see you tomorrow.